Valuation. Hello friends and welcome. Today we are going to talk 4 ways to analyze price to book ratio for effective valuation. Before we jump into the video, make sure you like the video and subscribe to our channel for more educational videos. Now let's get started. The price to book (P to B) ratio is a key metric for investors to evaluate a company's valuation in relation to its book value. Here are 4 essential methods to analyze this ratio effectively. Understanding the P/B ratio. The P to B ratio compares a company's market value to its book value, indicating whether a stock is overvalued or undervalued relative to its assets. Historical comparison. Examining a company's P to B ratio over time reveals valuation trends. A decreasing ratio may suggest undervaluation, while an increasing ratio could signal overvaluation. Industry comparison. Comparing a company's P to B ratio with industry peers provides insights into its relative valuation. A lower ratio compared to competitors may imply undervaluation, while a higher ratio could indicate overvaluation. Relationship with return on equity, ROE. The P to B ratio's correlation with return on equity, ROE, is vital. A higher ROE typically justifies a higher P to B ratio, indicating efficient asset utilization for earnings generation. Conclusion. Analyzing the price-to-book ratio involves considering historical trends, industry peers, and its relationship with ROE, enabling investors to make more informed decisions about a company's valuation. I hope that you liked the video and do follow our channel for more professional and business tips and other interesting videos. Thank you and goodbye.